Okay, so you have net working capital, we already covered it, current assets minus current liabilities. Okay, and you have this formula, you need to remember, I won't give it to you. Assets minus liabilities equals shareholders' equity, owner's equity, stockholders' equity. Net worth is the net worth or shareholders' equity, same thing. Net worth, remember that, net worth. Owner's equity, shareholders' equity, stockholders' equity.
So,
Book value of equity, yes.
is shareholders' equity, like you say, assets minus liabilities?
Total assets
Like-
minus total liability.
Like, okay, so all the assets,
Minus
all the liabilities?
all the liabilities.
And then which one is the one where it's just current assets and current
That's net working capital.
net working? Okay.
Net working capital is current assets minus current liabilities. All right. We covered this in chapter 3 also. Book value of equity, which is the owner's equity, another name. Book value of equity, owner's equity, shareholders' equity, net worth, multiple synonyms. You all know market value of equity, current stock price times number of shares outstanding, that's market value of equity. Okay, depreciation, remember, is a non-cash expense, okay? This is the progressive tax system here, progressive. What does this progressive tax system mean? It means that your income will be divided into multiple tranches or multiple, classes, The lowest class of your income, the lowest category of income, the lowest bracket of your income will be taxed at the lowest rate. And then the next one the next levels of income will be taxed at successively higher. So for example, if your income is 100,000, so now you have three tranches or three, you have to divide it into three parts, okay? The lowest level, the middle level, the highest level. The lowest level, this up to $50,000 will be taxed at this rate, okay? Then whatever falls in this will be taxed, so 50,000 falls here, 25,000 falls here. So 50,000 will be taxed at this rate, 25,000 will be taxed at this rate, and then whatever falls here will be taxed at this rate. So you have to perform multiple calculations, okay? Let's talk about the marginal tax rate. Okay, suppose your income is, right now your income is 75,000. What's the marginal tax rate? Who will tell me? I want to know if some of you remember. Your income right now is $75,000. You don't have to make any calculations. You can answer the question by looking at this chart, this table.
Take the first 50,000.
Now, your marginal tax rate. Your income, taxable income is 75,000. So what's your marginal tax rate?
It would be in the tax rate of 25.
You are trying to answer the following question. So the question is, if your income were to go above $1, at what rate will the next dollar of income, the new dollar, will be taxed? So if your income is right now is 75,000, and if it were to go above $1, that $1 will bring you here, 75,000 and $1. So your marginal tax rate will be this number here, 34%. So all you're trying to do is answer the following question. If your income were to go above $1, okay, will the $1, the new dollar, the extra dollar be taxed at a different rate than the previous dollar, or will it be taxed at a higher rate, the same rate or a higher rate? So that's the question that you have to answer. And now we have the flat tax rate, which is 21%. So that should be very simple to calculate. I'll give you a question just to give you, easy points. So if your income is 100,000 and corporate income is 100,000 and the flat tax rate is 21%, you just multiply the two and that's your tax bill. okay, as opposed to the progressive system. In the progressive system, you have to slice up your income into multiple tranches or parts or levels or whatever. I'll provide you all these formulas, but know the philosophy, what we are doing. Okay, so this is called the identity, accounting identity. So the left-hand side, that side is, did our firm, JCPenney, did they produce any free cash flows? Why do you call them free? Free means the firm has paid everyone excess, you can say, excess. So these are excess cash flows. So that's the left-hand side. And the right-hand side, so where do these excess cash flows go? They go to either shareholders and or lenders, long-term lenders, because those are the two entities that provide capital to the firm. So free cash flows produced equals free cash flows distributed. So that's the accounting identity. Okay? And free cash flow is also known by another name. All right. So this is expanding the left-hand side. So know the big picture. So from that big picture, we are, narrowing our focus. Focusing on multiple, the different parts of the left-hand side. So this equals, the left-hand side equals this. So this is what you produce from your business. But you must have made two types of investments. Investments in fixed assets, there is a formula for it. And investments in working capital, there is a formula for this. So this minus this. And how do you calculate? Because these are not formulas, so the formulas are given to you on the next page. So each of the three components of the left-hand side is calculated as shown on this page. So this gives you, so the first number minus the second number minus the third number will give you free cash flows. All right, and on the right-hand side now, this is the right-hand side, so this tells you a part of it, maybe nothing. A part of it goes to shareholders, a part of it goes to lenders. Okay. I posted, you must have noticed, I posted the solution to number 19 in Moodle. If you didn't check it out, I used Excel, and this is the solution. So if you highlight, you can find out, how I'm doing all these calculations. So that will tell you. So it should be straightforward. All right. Any questions? So. Please be on time. You'll have exactly 75 minutes. So bring a calculator, bring a type B Scantron, and I wish you best of luck. Yes. About 30 multiple choice questions, maybe 5 or 6, small problems.